In today's video, I bring you the strategy of the Three Musketeers. This is a long-term strategy that uses charts of more than 4 hours and can be used in any type of financial asset. In my case, I'm going to use it to operate the euro-dollar. The first thing we must do is select 3 stochastic indicators. The first one we will put with the parameters of 1455. We will change the color of the stochastic line to white and the signal line to red. We will also change the background to green. This will be the fast stochastic. To the second, we will put the parameters of 56-20-20. And we will change the background to blue. This will be a slow stochastic. Finally, to the third, we will put the parameters of 112-40-40, and we will change the background color to red. This will also be a slow stochastic. Ready? We have everything configured. But before starting with the strategy, let's briefly explain what it consists of and what stochastics are. A stochastic is an oscillator, whose main use is to know the levels of overbought and oversold. The overbought level is measured from the value of 80 to 100, and the oversold level from 0 to 20. We can see how the price rises when the stochastic was in the oversold zone, and as the price fell, when the stochastic was in the overbought zone. The stochastic also has 2 lines, the stochastic line and the signal line. The crossing of these lines could tell us whether to buy or sell. This trading strategy is based on 3 stochastics, 2 slow and 1 fast. For this strategy, the slow stochastics will be telling us which direction to trade. If they enter their oversold zone, we get ready to buy, and if they enter their overbought zone, we get ready to sell. Important here is that both stochastics are within the overbought or oversold areas. The fast stochastic will give us the signals of entering the market, this with the crossing of its lines, stochastic and signal. Let's see it with an example of a buy operation. First, we wait for the blue and red stochastic to enter the oversold zone, less than 20. Once they are oversold, we will open the order to buy. When in the fast stochastic, the green one, the stochastic line crosses the signal line, red, from bottom to top. We will put the stop loss below the last low and the take profit in a risk-benefit ratio of 2 to 1. This means that we risk 1 to try to get 2. Let us now see the example of a sell operation. First, we wait for the blue and red stochastics to enter the overbought zone, more than 80. Once they are overbought, we will open the sell order. When in the fast stochastic, the green one, the stochastic line crosses the signal line, red, from top to bottom. We will put the stop loss above the last maximum and the take profit in a risk-benefit ratio of 2 to 1. This means that we risk 1 to try to get 2. Now, let's look at some more examples. And ready, I hope this strategy has been useful to you. Do not forget that before trying it with real money, you need to try it in a demo account so that you can put it into practice by yourself. Do not forget to subscribe so as not to miss any strategy, as we upload the best strategies every week.